Ladies and gentlemen, we have crossed the Rubicon into a structural era of resource scarcity that the Western financial system is fundamentally unprepared to process. As of this hour, the global silver market has entered a state of terminal fracture. What was once whispered in high-level industrial boardrooms is now a mathematical reality on your screens. 48 hours ago, while the world was distracted by the turning of the calendar year, the Chinese Ministry of Commerce enacted a regulatory firewall that effectively severs the jugular of the Western silver market. By implementing a strict 80-ton annual production floor for export licensing, Beijing has not just regulated a commodity, they have weaponized a strategic asset that sits at the very heart of the 2026 technological architecture. This is not a drill, and it is no longer a matter of speculation. We are witnessing the first true commodity default of the modern era, as 65% of the world's refined silver supply has been pulled from the global marketplace in a single stroke of a pen. 1. The mechanism of this collapse is as elegant as it is devastating. By mandating that only state-certified firms producing at least 80 tons of silver annually can apply for export permits, China has purged hundreds of secondary and mid-tier refiners from the international trade loop. This move creates an immediate and irreversible supply vacuum in the London and New York vaults. For decades, the Western paper markets, the COMEX and the LBMA, have functioned on the comfortable assumption that silver is an ordinary commodity, a byproduct of lead and zinc mining that would always flow to the highest bidder. That assumption died on January 1st. By elevating silver to the same strategic status as rare earth metals, China has signaled that the era of just-in-time delivery for Western bullion banks is over. The firewall is up, and for those holding paper contracts in New York, the exit is now smaller than the eye of a needle. Look at the numbers, because the numbers do not lie. As we open the first trading sessions of 2026, the registered silver inventories at the COMEX have plummeted to 128 million ounces. To the uninitiated, that might sound like a significant reserve. To those of us who track the industrial burn rate, it is a death rattle. We are currently facing a January delivery cycle where intent notices have already exceeded 3,400 units, representing a demand-to-vault ratio that is physically impossible to satisfy without a miracle. But miracles are not in the business of commodity exchanges. What we are seeing instead is the total decoupling of price from reality. While the paper ticker in New York flashes a controlled, suppressed price in the low 70s, the real world has already moved on. In Tokyo, Dubai and Shanghai, physical silver is changing hands at premiums of 80% or more. Spot transactions are being settled at $130 per ounce because in a world of zero supply, the price is whatever the person with the metal says it is. The institutions are in a state of late-stage, reactive panic. We are receiving reports of emergency meetings between Tier 1 bullion banks and exchange officials as they grapple with the 90-day force majeure window. The LBMA has already issued private warnings to its members. If physical delivery cannot be met, contracts will be forcibly settled in cash. But ask yourself this: what is cash worth to a photovoltaic manufacturer who needs physical silver to keep their factory lines running? What is cash worth to an AI hardware giant whose next generation of HJT solar cells and high-end semiconductors requires the most conductive metal on Earth? It is worth nothing. This is why we are seeing the direct sourcing pincer. Companies like Longi and Trina, the titans of the solar industry, are no longer playing the paper game. They have moved to bypass the exchanges entirely, securing 200 million ounces in direct-from-mine contracts. They are the early informed players who realize that the COMEX is a ghost house. They are taking the metal at the source, leaving the retail investor and the late-arriving institution to fight over the scraps of a broken derivative system. This is the psychological framework you must understand to survive this transition. The institutions are stressed because they are late. They are reactive because they believed their own illusion, the illusion that paper claims could indefinitely replace physical atoms. They are currently being crushed by margin call cascades and liquidity shocks, as the volatility they tried to suppress has now become their judge and jury. Every price drop you see on the screen is a mechanical event, a forced liquidation by a bank that can no longer meet its collateral requirements. Every price rise, however, is a structural inevitability. The paper market is a hall of mirrors that is currently shattering, and the physical market is the hard, cold truth that remains when the lights go out. Geopolitically, the capture of the silver supply is a masterstroke. By ring-fencing 65% of global refined silver, Beijing has placed a strategic tax on Western innovation. They have realized that the transition to a green economy and the expansion of the AI frontier cannot happen without silver. To control the silver is to control the pace of the West's industrial evolution. This isn't just about a precious metal, it's about the choke point veto. When you control the input for every EV, every 5G tower, and every advanced defense system, you don't need to fire a shot, you simply close the license window. The 44 state-authorized firms that now hold the keys to the silver export market are not trading in the Western sense. They are executing a state-directed resource mandate. They are the apex predators of the new commodity cycle, designed to outbleed any public company that relies on quarterly earnings and open market procurement. The fallout of this 48-hour blockade is already visible in the banking sector. We are witnessing an accelerated flight of Tier 1 capital. Regional banks are seeing their institutional clients move physical assets into private non-bank storage because the trust in the custodial system has evaporated. JP Morgan, the custodian for the largest silver ETFs, has gone silent. They haven't reported a significant eligible to registered transfer in 2 weeks. This is the silence before the storm. It indicates a total freeze in institutional liquidity. They are no longer moving metal because they have no metal to move. They are hunkered down, hoping that the cash settlement provisions will save them from a total systemic collapse. But confidence is a one-way street. Once it is gone, it does not return. We are now in a countdown. The January 1st firewall was the first domino. Within the next 72 hours, we expect to see the force majeure triggers pulled in London. Within 14 days, the industrial supply chain panic will hit the mainstream headlines as manufacturing delays in the tech sector become impossible to hide. The paper-to-physical ratio, which some analysts now place at a staggering 378 to 1, is about to be reconciled. In a reconciliation of that magnitude, the paper is burned to ash, and the physical is revalued at multiples that the average person cannot comprehend. For you, the informed holder, this volatility is not a sign of danger, it is a confirmation of your thesis. Every time the paper price is hammered down by a desperate bullion bank, it only widens the gap with reality, making the eventual snapback more violent. Holding physical metal is no longer just a trade, it is a rational act of awareness in a world of institutional delusion. While the masses are waiting for a return to normal, you must understand that the normal of the last 40 years was a temporary anomaly supported by cheap energy and an abundance of unallocated resources. That era ended 48 hours ago. The Beijing Firewall is not just a policy, it is a border. On one side of that border is the old world of financial engineering, paper derivatives, and infinite liquidity. On the other side is the new world of resource nationalism, strategic materials, and the absolute sovereignty of the physical. The 80-ton rule has ensured that the Western exchanges will never again be replenished by the East. The vaults are draining, the shorts are trapped, and the delivery notices are piling up on desks in New York that have no way to fulfill them. We are documenting the breakdown of a global market in real time. This is the emergency briefing you were never supposed to hear, but the math has made it unavoidable. The silver to gold ratio is compressing towards 60 to 1, driven by a desperate price-insensitive demand that doesn't care about the Federal Reserve, interest rates, or the strength of the dollar. It cares only about the conductivity of the atom. In 2026, the atom is the only currency that matters. As the COMEX registered inventories head towards zero, and as the 90-day force majeure window closes, the world will finally wake up to the reality of the Beijing Firewall. By then, the decoupling will be complete, and the price of silver will no longer be something you check on a ticker. It will be something you negotiate with a sovereign state. Stay calm, stay informed. The structural transition is here, and it is moving faster than the headlines can keep up with. This has been an emergency broadcast on the systemic fracture of the global silver market. The firewall is up. The supply is gone. The countdown has reached zero.